Welcome to Lesson 7, Raising Capital Through Debt and Equity Financing. When implementing a new business concept or starting a new business, only one definition captures the real essence of capital. It takes money to make money. When we talk about capital in terms of small business financing, what we're really speaking to is the amount of financial resources that are going to be needed by the business to implement and execute the business plan. One of the most common reasons why a business fail is due to a lack of or inappropriately structured capital resources. So it's really important to understand that capital, the existence of capital, the existence of sufficient resources that are structured in the best possible way to serve the needs of the business has to be a consideration of starting a business for the small business owner. Four most important things for you as an entrepreneur, as a small business owner, to keep in mind. Number one is we never want to run out of money, because obviously that's not good. Number two, I really need to understand my business or my product, because I should be the expert of what goes on in my business. Number three, make sure that I have a very good product that meets the needs, the wants, and it solves the problem that the consumer has. And four, never run out of money. So obviously this is kind of tongue-in-cheek, but the reality of it is that that is one of the most important things that you have to keep in mind. And there is, just like we talked about back in lesson 5, lesson 5 and lesson 6, we talked about the importance of cash flow and projecting and understanding when are my cash, developing a cash budget so you understand where am I going to be low points in cash, so that I structured the need for capital in the most appropriate way for business. They are investors, and then they're investors. We call valued investors those who can provide you with insights and additional information that go above and beyond just providing you with the money. So if we think about friends and family, let's say that you have a family member who is interested in your business, thinks you have a good thing going here, and they would like to provide you with some money, right? They want to give you access to some money. And they are not aware or knowledgeable of the particular product or service that you have to offer. So although they are investing money, their background may not be in business, their background may not be in the product or service you're trying to offer, they don't have knowledge of the industry. So although we will welcome and will feel thankful for them trusting us with their money and willing to invest in our business, they can't offer as much insight or guidance on how to successfully potentially run the business. But then there are those individuals who may be investors who understand the industry, understand business, have done this type of business before. And so they are valued at in that they bring not just money, not just capital, but significant knowledge and information that is very valuable. And just being partnered with them or having them be investors in our business builds credibility and legitimacy because of who they are. Those who can help the new business owners develop new customers, identify employees, and additional sources of capital. So these would be folks that are connected and that really can provide a significant amount of contribution to the business, not just financial contribution, by the way. So just to give you an idea of where does small businesses get money from, where does the money that small businesses need, the capital that they need, come from when they start out? Well, 33% of small business owners don't require any financing. So there's a third, that say, I don't need any financing to start my business. I know that when I started my business, my consulting practice, I didn't need any financing to get it started. What I needed, I could do myself, and there wasn't much that I needed in terms of financial resources. 41% of capital for those that do need financial resources to start up their small business comes from personal and business credit cards. So there is a significant amount, the majority of small business owners, majority of small business startups finance their startup on their personal credit cards or on credit cards that have been acquired for the business. 34% of capital comes from bank loans, and that's debt financing that we consider. 24% of small business owners' capital comes from friends and family, and that could be debt or equity. So it could come in the form of debt or it could come in the form of equity, meaning that they can be partial owners if that's what they would like or that's what they are wanting, or they could just loan you the money, right? It's just a loan that they're giving you. And then finally, 18% comes from the small business owner's savings accounts. So there's those small business owners that go out and save their money, and when they reach the magic number that they have established for their startup expenses, then they start the business. You notice that I have not mentioned anything here about angel investors, about venture capitalists, about financial institutions, because when you're first starting, those entities play no role because they're not interested in funding. Those entities that I mentioned are interested in coming in once the business has been established, right? So once the business has a little bit of history, a little bit of data that indicates its potential, then they may become interested in working with you and helping you grow and advance the growth of the business. But up until then, at the very start of the first, I would say, year, 2 years, 3 years of existence of a business, they are on their own. And this is true of most businesses. I would dare say that businesses that you think are commonplace today, Microsoft, Apple, Facebook, Twitter, these were all businesses that were started for many years. They kind of lived through those credit cards, through personal savings, through family and friends providing support in those first year, 2 or 3 years of existence, until they had a little bit of history. They had a product that demonstrated viability. They had financials that demonstrated potential, and then came rounds of funding or potential to go to a financial institution. So when we look then at the sources of capital available to small businesses, we break it down into 2 categories, right? There's, multiple categories that come, financial resources comes in countless forms, types, structures, but the 2 main basic types really are debt and equity. And so I kind of just shared with you that debt and equity, neither one of which comes at the very beginning, unless it's through my own debt as an owner, going out and getting a personal loan, or my friends and family wanting some kind of equity investment into my business. So what is debt? How do we define debt financing? Well, debt is money that is provided to you and I as small business owners in exchange for my word, for the most part, particularly at the beginning, or some tangible assets such as the rights to intellectual property, inventory, trade account, receivables, real estate, personal guarantees, that the original investment plus some interest at a predetermined fixed or variable rate will be paid back over a period of time. So it represents a liability or an obligation of the business. And debt is usually governed by mutually agreed upon terms and conditions as provided by usually the party that is extending the credit. So the bank usually establishes those terms on the debt agreement, including interest rate, repayment term, periodic payment, collateral that would be required, and any other elements that they see fit as part of the agreement. The terms conditions have to be adhered to by the business, or it may run into the risk of default. So when we evaluate debt, there's two components that we have to think of in terms of the characteristics of debt. There's usually a maturity component and there's usually a security component. Maturity refers to the length of time the debt that, the debt comes due. So how much time is there until repayment has to take place, right? So any debt instrument requiring repayment within a year or less is usually classified as current or short-term debt. And we'll talk a little bit more about that. Security refers to the type of asset the debt is supported by or secured with. So is there going to be some kind of collateral that is going to be required? If you have good credit, you can potentially get a personal loan for up to $20,000, $25,000 to start your own business, right? But if you don't have good credit, then you may not be eligible to get a personal loan, and you may be required to have some kind of collateral associated with it. So for a business, it may be equipment, it may be, or even on a personal basis, it may be your car, it may be a second mortgage, which many businesses have been started with second mortgages. There's something there that is going to be partially, that is going to be the collateral that says that in the event that you're unable to pay the debt, then this particular item, this collateral, the security that has been used, will be used in order to satisfy the money owed to the bank or to the financial institution. In order for a financial institution to consider debt financing, they usually want to see a business's total debt equal to 1.5 to 3.7 times their earnings before taxes, depreciation, and amortization. So again, you have to understand what that is for your business, and that is why we talked about the financial analysis component, is because when pursuing a loan with a financial institution, you're going to want to know that before you ever set foot on that financial institution's door, because otherwise it makes no sense. There's no reason why you should if you don't meet that minimal requirement. So types of debt, short-term and long-term, that are available to you. So when we talk about short-term debt, it's debt that must be paid within the next 12 months. Usually falls into two categories: revolving debt, which is usually used for working capital for a business, or current maturity of long-term debt. So usually short-term debt is found in the balance sheet in the current liabilities section. And usually short-term debt by an established business is used to buy inventory and pay for day-to-day operating expenses. So when we look at short-term debt, is really in that cash flow budget. We recognize that at some point throughout the year, we are not going to meet our cash flow requirements. And so we're going to go ahead and tap into a line of credit, which is revolving debt, or tap into a short-term loan so that we are able to cover our cash flow requirements all throughout the year. Sometimes we also use short-term debt as a source of to purchase inventory. So if I am a boutique, for example, a clothing boutique, I know that my busiest seasons probably tend to be around Mother's Day, a women's clothing boutique that would be, or around Christmas time. So I may take out a loan or use a short-term loan or use revolving credit to purchase extra inventory around that time, because I know there's opportunity to capture customers who are going to be coming in, as well as during the Christmas season, so I can have sufficient inventories, variety of inventory that would be available to the customers. Usually, short-term debt costs us a little bit more than long-term debt in terms of the interest that I have to pay for that. Long-term debt, on the other hand, is the debt that must be paid back over a period longer than 12 months. Again, it's found in the balance sheet in the long-term liability section. And when we talk about long-term debt, we're looking at purchasing equipment, real estate that has to be bought. So it's a significant amount. Purchasing a car, if you're a florist and you now want to do deliveries, so you're going to usually take on a long-term debt in order to purchase the delivery van that will be used. Many businesses today are using delivery services. So those delivery services, the equipment required for that would be part of a long-term debt. When a business is said to be highly leveraged, and we've used that term before in our discussions throughout the semester, it usually means that it has a large amount of long-term debt, right? And becomes a bit of a worry for us or for the lenders when a business has that. It's said to be leveraged. So what are the advantages of debt financing for a small business, established small business? Well, you retain complete ownership. Nobody is going to come in and try to tell you what to do or how to do it in your business because it's just a loan, right? This is just a transactional agreement. Usually the cost of capital is low, right? Probably small business loan is running today with a business that has good credit, probably about 6%, 5.5%, somewhere around there. So it's not bad. The beauty of it is that the loan payments are predictable. So over the next 12 months, I have, my payments are $250. So I know they're not going to go up, they're not going to go down. It's exactly $250. You have a lengthy period, payback period. It can be a 3-year loan, a 5-year loan, a 7-year loan, and you have plenty of time to pay that loan back. It can involve value-added lenders, which are lenders that not only may be working with you on a loan, but maybe the bank that you are doing transactional day-to-day business with, where you have your checking account, your savings account. Maybe that these folks are also being able to provide long-term debt. So there's a variety of good possibilities with having lenders on your side. And it provides the tax benefit that the interest on the loan can be a write-off. The challenges of debt financing is that usually there's some kind of guarantee that's required. That's security component, right? So the security component could be a home, a car, equipment, other assets that the business owns. And they may be critical assets if you're unable to pay back that loan. The lender can force the business into bankruptcy because they're going to demand repayment of that loan. And so if you are unable to do so, you may have to, as a last resort, avail yourself of a bankruptcy filing. The amounts may be limited to the value of the company's assets. Usually you're not going to be able to secure a loan for anything greater than what the value of the total assets of the business are. So that might be a challenge. If you don't have many assets, you may not be able to secure a loan that's very large. And so that could be potentially a hurdle to overcome. And payments, although consistent, right? It's fixed payment, it's a fixed amount. They're due regardless of whether or not you've made a penny, right? Whether or not you've made a penny of profit, those payments are due. Whether or not you've made reach the sales goals that you wanted to reach, those payments are due. So it's something to really consider in terms of if this is the right route. And again, when I talk about debt financing, I'm really now talking about a business that has been around for a year, for 2 years, for 3 years. This is really not necessarily geared towards the small business startup or the entrepreneurial startup. So what do I recommend for entrepreneurial startup? Well, we call it the bootstrapping strategy or the personal savings strategy. Most common source of business financing when the business is just getting started. Now, even the owner's initial investment can be treated as money lent to the company with a reasonable interest rate. And it's something that if you work with your accountant, it can be set up that way. That you have loaned the business $15,000 and the going interest rate that you would have been charged for that $15,000 would have been 5.5%. So it is put into the financial statements that way. And then there is the potential for repayment mechanism, which allows you to receive capital from the company without the money being taxable, because it is simply the return of the original investment or loan payback, right? So it's something to think about if you have the availability of the funds, right? If you're using funds from your savings. Another source, again, we've talked about this, is friends and family, which is, again, another one of the most common sources of small business financing, especially during the startup stages. Usually, as I said, bank and other institutional debt providers do not supply startup capital because it's just too risky for them. In their mind, they have that figure. Hey, 50% of small businesses fail within their first 4 years, and 7 out of 10 fail within their first 10. So they are not eager to take on that challenge. They're not eager to take on that risk. Benefits of working with family and friends is the providers of loans is that they want to see you succeed. So they tend to be positive and enthusiastic. And if the repayments cannot be made, this kind of lender tends to be a little bit kinder, right? They tend to, for the most part, not force you into bankruptcy or not force you into losing it all. Now, there's still drawbacks, and I want us to be really aware of what those are. I am by no means advocating for you to have family and friends invest in your business. I think that it's a source, and many people have used that source, but I think that there's things that you have to consider, right? They, for the most part, as I said earlier, do not tend to be value-added investors. They usually don't know much about the business. They can't contribute guidance, mentorship, support, because they may not have that expertise or that experience. They're also not sophisticated investors, so they may not understand that this is an investment, this is a loan that they may lose completely, and that there will be no return on this investment, right? That this is something that is going to potentially be lost, and that they should be okay with that. They often expect to be repaid no matter what. And if you fold the business and you don't have any money to repay them with, they may not be happy. And that could obviously cause a significant strain in the personal relationship. They may not understand that they're not entitled to any ownership, only the principal repayment and the interest to be paid. So they may think that the business is growing back and growing and expanding and you're being really successful, and they may think, well, I own part of that business. Well, no, you loan money to that business. We're paying you back what you loaned us plus interest, right? And when that payment is completed, then that's where our relationship will end. And last, but probably one of the most important factors in considering whether to pursue family and friends when you're seeking debt financing is the high potential for the damage to the family relationship or the friendship. I often equate going into business or seeking financing from friends and family as a marriage that could potentially end up in divorce. And so there could potentially be tremendous challenges created if this is a route you choose to pursue. So I caution you to evaluate it, think it through, really consider, is this something that would work for me and the family, my family and my friends, because it should not be taken lightly. So I recommend some things if your source of capital is family and friends. I would recommend that you only go to those to raise money that can afford to lose it all, right? So don't go to people that are struggling to make ends meet, or that are giving you their personal savings, or the aunt who is 62 years old and this is her retirement money. It's just not the right thing to do, and you're not going to feel good if something happens and the business is not successful. I also recommend very strongly that you write a very long and detailed loan agreement, which highlights the interest rate to be paid, the repayments amounts, and what is the expected payment dates. Treat it as if this was a formal loan that you have taken out with a financial institution. The agreement should give investors the right to convert any or all of the investment into company stock, thereby giving them ownership stake if they want to at some point in time. It's something that helps people feel good, may also help lessen the idea that, well, I thought that I was going to own part of the business, and it does so in a more formal way. Personally guarantee at least the amount of the investment, and at most the investment plus the amount of interest due, right? So if you can, personally guarantee that, because I think that gives people peace of mind. Again, it gives them the feeling that you're serious, that this isn't just a fly by the seat of your pants kind of idea or thought, but that you have really gone in and given it some thought and given it some consideration to the level that they are giving you this. Another source of debt financing, which comes later in the life cycle of a business, would be angel investors. What are angel investors? Well, they're active investors who understand the risk of private investment. So they're typically former entrepreneurs who focus on industries that they're familiar with, and they have money. They have maybe made money, and now they want to invest in companies that have potential. So if you think of angel investors, would be the folks that participate in Shark Tank. So Draymond Jones, Mark Cuban, Barbara Cochran, those are angel investors. That's kind of to give you a picture of what that would be like. They provide a whole lot of money to seed and startup capital in the US. Close to 90% of the early stage capital provided comes from angel investors. So let's say that you start up your business, you started up bootstrapping with your personal savings, personal credit cards, maybe some family and some friends. You go along and the business continues to do well, you continue to grow. And the business now has some historical data of its viability, and you find an angel at that stage. Usually that is where they kind of pick up. Again, they don't do per se startups, but they do early stage businesses, which are just a step removed from the startup. Most angels are going to require an equity stake in the business, although some are willing to structure the capital as debt with a higher interest rate than a financial institution would ask of you. But they're taking the risk on a business that a financial institution will probably not take the risk on. So when we think of benefits versus drawbacks of angels, they tend to be more flexible with their terms than financial institutions, and they can make their own rules for lending you money, right? So it is up to them. And if you have watched Shark Tank, you'll see that sometimes they want an equity stake. Sometimes they're just loaning the money. It just depends on the business and what they see as the viability or the need of that particular business owner. The drawbacks, the cost of debt capital from angels is usually much, much higher than that of institutional financing businesses, so banks and lenders. It is not unusual for an angel to charge 2% per month, which would equal to 24% annual rate, which is much higher than what a bank would charge you and what a credit card would charge you. The other drawback of angels is that they want to see this business succeed, and because they have expertise or experience and knowledge in an industry or in that type of business, that's usually why they're investing. They're gonna want to be involved. So they're not going to be hands off like the banks would be, or the credit card companies who don't even know you're using this to finance your startup. They're going to be asking questions. They're going to be wanting updates. They're going to want to be involved in the business day-to-day management. So that's something, again, that if you have not encountered before, that may be something to consider as you evaluate this as an option for finance. Other sources of debt financing would be foundations. So for philanthropic organizations that, these are philanthropic organizations that provide grant loans primarily to nonprofits, businesses. Some of these foundations have broadened their loan activity to include some for-profit companies that provide some social good. So there may be funding available for a business even if it's for-profit through a foundation. Usually eligible companies are those that explicitly state their charitable or educational intentions to improve society. So if that's not where your business fit is, then this option is definitely out the table, out of consideration. Foundations sometimes also provide funding or loans to community development corporations, so CDCs, they're known, who in turn around and use that money to provide business loans for-profit businesses and nonprofit businesses. And the beauty of CDCs is that the loans they offer tend to have very low interest rates and very long-term repayment periods. So again, this is another option. If you are a nonprofit, this is an excellent option that you should explore. There's also opportunities through government lending. Local, state, and federal government agencies have programs for providing loans to entrepreneurs through the SBA, the Small Business Administration, and the CAP, which is the Capital Access Program. The challenge with these loans is that it requires a tremendous amount of paperwork, documentation, and it takes a tremendous amount of time to get all of that processed. It's a government agency, and you have to accept that there will be some bureaucracy, there will be some slow moving, and as I record this lecture, none of those agencies is open because of the federal shutdown. So if you were a business that was awaiting loan approval or the paperwork to be processed to be evaluated for a loan, you are kind of, your hands are wringing because, oh my gosh, when are these folks going to open up so that I can get an answer? So it comes with those challenges. Also, you as the applicant have to personally guarantee the loan. So that it's another challenge that may come that you may not be prepared for. So let me talk a little bit more about the CAP program, the Capital Access Program. This is a credit enhancement program that induces banks to consider loaning money that they may not otherwise have lent to people or businesses they have rejected because of deficiencies in collateral or deficiencies in the cash flow of the business. So the bank and the borrower pay a fee between 3 and 7% of the loan amount to a loan loss reserve account that is held by the bank. The loan loss reserve contribution is matched by the state or by the local money, with the total reserve then growing to either 6 to 14% to cover any losses in the event that the business goes out of business, is unable to fulfill its obligation. The bank gets to set the terms, gets to set the rate, the fees, the collateral required. If you're interested in finding more about the Texas cap loan, I've given you their link that you should be able to follow, and will take you to further explore this particular option. Now let's talk about the Small Business Administration Loan Program. Again, just to clarify, and I've said this I think in one of the other recordings, the Small Business Administration does not make loans. They partner with commercial banks and other financial institutions who are the ones who in turn make the loans. The loans are guaranteed by the SBA, and that allows them to be able to offer additional funding. 1/3 of SBA's loans goes to startups. The remainder usually goes to already established businesses. The SBA lenders fall into 3 categories: general, certified, and preferred. And there's a listing of SBA lenders in Texas. If you look at the SBA resource guide provided to you in the articles, videos folder for this particular lesson. Oh, and before I forget, the SBA only guarantees up to 85% of the loan. So there's a bit that they're not going to cover. So depending on the loan, the SBA will charge between the lender a fee between 2 and 3.5% of the loan, which in turn the bank passes on to you and I as the small business owner seeking that loan. All investors are required to have 20% equity or more and to personally guarantee the loan. So this is what I was talking about in the couple of slides ago, that you're going to have some skin in the game. The SBA doesn't make these loans without you having some skin in the game. So 20% equity has to come right from you and personally guarantee the loan through some means. To qualify for a loan, the business has to qualify as a small business, and you can do a search for whatever the size the SBA considers small business, and you'll be surprised when you see those. You have to be for profit, so nonprofit businesses cannot take advantage of the SBA loan program. Not have the internal resources to provide the financing, meaning that you cannot have money stashed away and then you say, well, I don't really want to use that money. I want to go ahead and get a loan through the SBA. They won't allow you to do that. And then obviously demonstrate the capacity to be able to repay the loan that you incur. So the different types of loan programs that the SBA has, the most popular probably is the 7A loan guarantee program. It's a conventional loan that they work with lenders with up to $5 million that receives the SBA guarantee. The SBA will guarantee the 85% of the loan up to $150,000 and 75% of the loan for any loan above $150,000. The money can be used for commercial real estate, for business equipment, for machinery finance, to refinance an existing debt, for construction, for working capital, variety of reasons. I know that you would think that, well, it's my loan, I'm personally guaranteeing it, I have 20% equity in it, what the heck? Well, they still kind of set the parameters for what you can and cannot use this loan for. A second program that they have that it's become very popular is the SBA Express Loan Program. And this loan program allows lenders to offer revolving credit lines that are renewable annually for up to 7 years and are provided within 36 hours of the request being filed and approved. So once it's renewed, once it's approved, the revolving credit keeps adding funding to the business within 36 hours of the business requesting it. The loans tend to be under $25,000 and don't require collateral. The maximum amount can be $350,000, and then but that $350,000 level requires a 50% loan guarantee. So if you're going to apply for a small business administration loan, what do you need to know? Well, for loan pre-qualification, applicants with less than $250,000 requirement can be reviewed and potentially authorized by the SBA before the loans are taken to the lenders, right? So the SBA will get your application, all the paperwork you filled out, all the documentation that they've required that you provide them with, you have, and they can review. If the loan is for less than $250,000, they can review it and they can authorize it before you take the paperwork to the bank saying, hey, I have an authorized SBA loan. And they'll give you information on who are the local lenders that they work with for the level of loan that you're requesting. The Small Business Development Centers provide the review service. That's what SBDC stands for free. So you just have to go to them with the completed paperwork and all your documentation. And we here at Tarrant County College house and partner with the Tarrant Small Business Development Center. And again, I've provided you with that link in case you're interested in finding out more about it. If it's for the microloan program, which is part of the CDC, the Community Development Corporations program, those are administered by them. And I'll give you some links of sample lenders, CDC lenders here in Texas. These are the smallest loans guaranteed by the SBA, and they range in amounts between $450 and $50,000, with the average loan really being around $13,000. And the microloan program is intended, the SBA has gotten a lot of pushback from the perspective that startups don't have sufficient funding, right? There's not enough people offering early startups funding. And so it's kind of a catch-22 for the small business owner. How can I start my business if I have no funding and there's no funding available? But you're the Small Business Administration. Why aren't you helping us? So they have created this program twofold. One is to address that concern on the part of you and I, small business owners. And two, it's also for small business owners who may have an existing business that they started with zero financing. Now the business is growing because they didn't need financing. The business has grown. There's been in business for a couple of years. They need money, but the credit of the individual is not very good. And so this microloan program allows for small loans to be given in order to demonstrate capacity for repayment and meeting the requirements of establishing credit for the business, and so on and so forth. And that's really the reason why this particular program has existed, but it has become very popular, and one that I believe that the Small Business Administration is really trying to address that concern of the small business owners who say, well, how am I supposed to start a business if you don't lend money to businesses who are just getting started? The next program that the Small Business Administration has is the 504, which is it's a CDC or real estate equipment loan. Really, 504 program is CDC or real estate equipment loan. And this is for long-term debt. This is long-term financing. You know, you're having to acquire assets, equipment, land, real estate. So this is long-term type financing, not short-term, not small, just really long-term. And usually these type of loans are issued to, again, businesses that have been in business for a while, small businesses, and now are having to grow. So I'm having to move my warehouse that I'm leasing to one that I'm buying because of the size and the type of setup I need. So now I need a loan to go out and purchase this particular new warehouse that I'm needing. The funds cannot be used for working capital. They cannot be used for inventory, and they cannot be used for repaying of debt. So they're very, very limited. This particular program is very limited in what we can use the money for if we acquire the loan. So some advice in making sure you're successful potentially if you show up to that SBDC office and you're seeking an SBA, Small Business Administration loan. First and foremost, clean up your personal finance if you have problems. Reduce the credit card debt and the number of credit cards that you have. Know your FICO score, which is the score, our credit score. Check with the major credit bureaus and make sure that there are no errors on your report, or hopefully no identity theft, nothing that may raise a red flag for those reviewing your credit. Define your goals realistically, right? So think about, how much do I really need, and apply for that specific amount, and then be able to articulate in writing in detail, how will I use these funds to further the growth of my business, right? To further enhance my business operations. Develop realistic performance. Talked about this a few lessons ago, that show that even under the worst case scenario, you are capable of repaying that debt. Begin early. Apply for financing at least 6 months before you need the money. Please remember, the Small Business Administration is a government entity. It's a federal government entity, and it's not going to move at the speed that you and I, small business owners, usually respond to our customers, or even a banking or lending institution. So you have got to be a good planner if you are going to take advantage. And by the way, pack your patience. Pack your patience. Work with lenders that have certified or preferred lender status with the SBA. Submit a business plan that is going to knock their socks off, that is thorough, that is specific, that addresses any concerns and all concerns that an investor evaluating your business would. And last but definitely not least, don't lie, don't enhance, don't hide. Just provide what you have, right? If they're able to loan you the money, if you qualify, then you should qualify on the reality of what your business is, not something that is non-existent or that is not available. So when we think about, and again, advice for getting the loan is ensure that you minimize risk and ensure full repayment of loans. Banks and other lending institutions use what's called the 5 C's of credit to evaluate your ability and willingness to pay back the loan. So what are the 5 C's of credit? There's capacity to repay the loan, which is the most critical, right? There is, the lender will want to know how you intend to repay the loan. There is capital, which is the money you personally invest. They want to know that you have a skin in this game. Just like when you purchase a home, they want to know that you are providing some kind of down payment. And that tends to be sometimes the availability that there is. Capital should be something that you have saved for, that you have available, that you have invested in. Third C is character, refers to your personal integrity, and here really is where they're going to look at your credit report. Have you repaid? Have you really done a good job of re-examining what you have? Collateral is a form of security you provide to the bank. So giving collateral to a bank means that you pledge an asset you own, your home, to the bank with the agreement that if in the event that you don't repay the loan, that they're going to take that asset and use it for the purposes of repayment. Last C is conditions, and that has 2 meanings. The first refers to the conditions of the loan. How will you be using the money? And the second, to expand, to purchase equipment or the inventory. And the second refers to economic conditions at the local level, in your industry, which in turn could affect the success of your business and in turn affect your ability to repay that particular loan. One of the things you're going to have to do, unfortunately, because it's going to take you a significant amount of time, is collect all the pre-application information that will be needed. So what is that? Well, they're going to want personal tax returns of all owners and investors with at least 20% ownership. They're going to want to see personal financial statements of all investors. They're going to want to see the ownership documents. So if you have incorporated as a C Corp or an S Corp, or have created an LLC, limited liability company, they're going to want to see that. If there's a partnership agreement, they're going to want to see that. They're definitely going to want to see a business plan. If you're a startup, if you're an established business, they're not going to be too sticky about that. But if you're starting out in the early stages, they're going to want to see that. And then they're going to also want to see what is the available collateral. Are you putting your house up, your car, or the cars that the business has? What are you utilizing for collateral? For an existing business, you will need most of the above and tax returns for the past 3 years, interim financial statements, and the business debt schedule, right? So these are all things that you're going to have readily available. As you can see, it's not something that you cannot do, but it's something that is going to take you time to gather and compile and put together. All right, another source of debt financing comes from community development financial institutions, CDFIs. Everything in government has an acronym, so here we go. Community development financial institutions provide loans, financing to businesses that are generally unbankable by traditional industry standards. So they cannot go to a bank, businesses that traditionally cannot go to a bank. Usually community development loan funds, banks, credit unions, and community development venture funds. So they're able to make riskier loans because they're not restricted by the FBIC regulations in the same way as depository banks, as commercial banks and commercial credit unions. It is usually a good place for businesses to start, for a small business or a growing business whose returns potentially are not high enough just yet to spark or capture the interest of an angel investor, as well as for owners with less than perfect credit. And again, I give you a link here to help you do some research if you're interested in finding out more about CDFIs. Another source of debt financing would come from what we call factoring. Factors are asset-based lenders. So what can you get from factors? Well, it's obtaining cash by selling your accounts receivables to the factor at a discount to invoice value. So what does that exactly mean? Well, it just means that your accounts receivables are worth money, right? And potentially you may not want to, have the time to, or need cash immediately. And if you sell your accounts receivables to these factors, which are businesses that all they do is buy accounts receivables, what they will give you money, cash, in exchange for buying your receivables. So they usually will charge a fee for servicing accounts and for amounts advanced to the firm prior to the collection. There tends to be two types of factors. There's recourse factors, and those are factors that buy receivables with the agreement that any receivable that they don't collect on will be reimbursed by the client, right? So I'm going to give you, let's say that I have $50,000 on receivables, and I'm a factor. I say I'm going to give you $40,000 on receivables because my fees for servicing the account and my fee for advancing you this money before I collected is going to be $10,000. So on a recourse factor, if the agreement you enter with is with a recourse factor, they're going to say, okay, if we're only able to collect 37,000 of the 40,000, you still will owe us 3,000. On our non-recourse factor, they say, hey, don't worry. We are going to give you 40,000 for these $50,000 worth of receivables. If we collect 40,000, great. If we don't collect, if we collect the 50,000, great. If we don't collect the 50,000, no skin off your back. All right. So that's kind of how it works in terms of factors. But it's definitely a way for businesses, particularly small businesses, to collect, to be able to acquire cash quickly if they need it. Customer financing, it's another way of acquiring debt financing in order for day-to-day operations. So there's times when customers may be willing to provide capital to suppliers who provide them with a high quality or unique product, which they may not be able to get anywhere else. So sometimes if you are customizing a product, you're customizing a service, customers are willing to pay for that because they want the customization of having the ability to have a unique product to sell or a unique product service to offer, right? That they cannot get anywhere else. So they may do this through a direct loan agreement or a down payment on a future order. Now, the drawbacks of using customer financing is that because you're having to cater to these particular customers who've now financed your operation to some degree, you may lose out on other customers who are competitors of your investor, right? So other customers may say, you know what, your loyalty is to that person because that person is lending you money. I don't want to do business with you because you may not pay as close attention, excuse me, to my products. Your customers also may gain access to key information on how your operations work because in order to give you the loan, they may ask for that. And it may be challenging for you to raise prices on those customers since they will know exactly how much it costs you to produce that product. And they may ask for an arrangement where they are able to be charged only a little bit above the cost of making price. Another option for debt financing is through supplier financing. There's many suppliers who give credit to their customers because they know that it's worth it. So anytime that vendor may say, okay, you don't have to pay me for 90 days on the supplies that I just provided you, that's technically debt financing, right? They've given you a loan basically of 90 days. They've given you the product for 90 days without you having to pay them back. There's some businesses that will, in order to sell you their product, they will self-finance the product. So they'll create a financial mechanism by which they loan you the money to buy the product or the equipment, whatever it is, and then you pay them a monthly amount. Drawbacks again here is the supplier may require for you to buy all of your product from them. And again, other suppliers may refuse to do business with you because now they perceive your loyalties as being with that particular supplier. Another source of debt financing for working capital would be credit cards. And if you have good credit, and the business has established a little bit of credit, then they can be cheap sources of working capital. But you have to be careful how to use them, just like in your personal life. Using credit cards that have an introductory rate of as low as 0% would be beneficial. You can use them as interest-free short-term loans, which requires you to pay them back at the end of each month when the bill comes due. Use only those that have that grace period for payment, and don't use them as cash advances, right? So use them to buy supplies, to buy inventory, things that maybe you need now that you know you're going to have payment for by the end of the month, which is when the bill will come due. But you have to be extremely careful with using credit cards because they could really quickly can become a crutch that you use in order to finance the business. And then you'll find yourself in a really challenging financial condition with the debt that is owed to credit card companies. So let's now talk about equity financing. And again, equity capital is money provided to the business in exchange for ownership on the business. So usually an equity investor receives a percentage of ownership that ideally appreciates in value as the business grows and becomes more successful. The investor may also receive dividend payouts, a portion of the business profits, etc. So there's multiple benefits for those that choose to provide money to a business in exchange for ownership stake. So what are some of the pros of equity financing? Well, there's no personal guarantees, right? You don't have to have a collateral. You don't have to offer any kind of personal guarantee that the money will be repaid. There's no regular cash payments month to month. You don't have to repay a debt that is owed. There can be value-added investors, right? If we think about those angel investors, instead of lending you money, they're going to be investors, equity financing investors. They bring, again, a significant amount of knowledge, experience about the industry, about the business. They have connections, they have networks that they can tap into to help you. Equity investors cannot force the business into bankruptcy. So because they have given you money doesn't mean that they can say, well, sorry, you're going to have to repay us this money any way you can. And if you can, we're going to have you go into bankruptcy. Usually businesses that have equity stakes or investors tend to grow at a little bit of a faster rate, right? So that also tends to be a benefit of equity financing. Now, nothing is perfect, so equity financing also has its cons. The dividends are not tax deductible, so when you pay those dividends out, that's where there's that double taxation we talked about early in the semester. You as the entrepreneur, as the small business owner, now have ownership partners, right? There is going to be people who want to provide you with information and guidance and day-to-day management recommendations. So the management influence can be significant. So it's not unusual for early stage equity investors to secure the right to influence who sits on a board of directors. So if the company has determined that 5 board members are needed, the early stage investors may carve out the right to elect 2 of those board members. So that tends to kind of impact your running of the business. Equity investment can be expensive because you're giving up part of your hard work, business, ownership into that business. And under the provisions of equity investment, once you create that board, the investors can say, well, you're not doing a very good job, Mr. Entrepreneur, you started this business, of running this business. So we're going to replace you with somebody that maybe has better knowledge, better understanding. You may still have partial ownership or significant ownership in your business, but you won't be the one necessarily running the day-to-day operations of the business. And I actually was part of a startup where that's exactly what happened. The founder never got to see the company go public. They weren't part of the growth and expansion. The business reached a point where that founder had to exit or was exited by the board of directors that he created because they didn't feel that he was moving the business in the right direction. And so it could happen. Personal savings can be a source of equity financing. I know we put it as a source of debt financing, but it also can be a source of equity financing. When an entrepreneur invests their own money on the business venture, it should be either in the form of debt or in the form of equity. If it's debt, then there should be a repayment agreement entered into and an interest rate paid, or it could be in the form of equity, which means that you have ownership, a stake of ownership in the business. This will allow you to recover your investment with only the interest received subject to those taxation. Angel investors, again, fit both categories, usually get a large ownership position in the company since the company valuation tends to be low. Angels will usually expect annual returns in excess of 25%, so pretty high threshold to fulfill if you pursue an angel investor who wants an equity in the business. There's also the opportunity to do private placement offerings. And what this means is just a confirmation that money is being raised from individuals or businesses, organizations that meet all of the standard regulations of the U.S. Securities Act of 1933 and Regulation D rule restrictions. It's ideal for high risks and small companies, and offering can be for all equity, all debt, or a combination of both. So this is another source of equity and financing. Then we start kind of looking at the big players when it comes to equity financing. So corporate venture capital firms, which are large corporations who invest in startups. And I should really change that because startups is, by this point, they are year 2, year 3, and in the millions in terms of revenue. They have products or services related to the industry where they have knowledge and expertise or an interest. There's also private equity firms, which are institutional investors who enter into a private contract or a private deal with the founders and the owners of a startup. And again, they're usually small companies that happen to be in the business of providing capital, and they're willing to do some financing. But again, the same rules of what are the pros and cons of equity financing apply here. So something to be aware of and something to be careful with. Private equity firms set up as either limited partnerships or LLCs. The professional investors are the general partners. They invest usually between 1 and 5% of their personal capital in the fund and make all the decisions. The external investors are the limited partners, and they commit to a specified amount of capital for the new venture fund. So you will see oftentimes that there is businesses that, whether as a startup or whether as they grow, fall into these private equity firm fundings, and this is sort of how they're structured. The private equity firms seek investment in companies that will be experiencing a tremendous amount of growth. 20% growth year over year is a tremendous amount of growth for a business. The industry the business operates in must be large enough to sustain 2 large successful competitors, have above average gross margins, have the potential to increase in value sufficiently in 5 to 7 years for the investors to be able to realize their minimum target return. So these are big players. Private equity firms are not small players. They're not looking at small business players. They're looking at businesses that are going maybe from year 1 to year 3, small development, and then year 3 to year 5, they're going to grow by 30, 40, 50%. Those are the kinds of businesses that they're looking at. Private equity firms' advice is that you should seek investors who have an inclination for your type of business, those who are buying what you are selling. Get an introduction to those investors prior to submitting your business plan. Understand what is it that they're interested in, what is it that they're looking for, and see if your business fits that category. Again, private equity firms are not for those of us that are starting. These are for businesses that have kind of taken hold. If you think of private equity firms, think of year 3 of Snapchat, year 2, actually longer than that, year 5 of Facebook. So these are the firms that are going to kind of take hold and really see the potential for growth, but the potential for growth has to be a pretty steep incline, because they're not going to go for those businesses that are growing 5% year over year or 10% year over year, because they're not going to give them the return on the investment that they're seeking. Another source of equity financing would be small business investment companies, SBICs, which are privately owned for-profit equity firms that are licensed and regulated by the Small Business Administration. They tend to invest in businesses that employ less than 500 people and are showing a net worth that is not greater than 18 million and after-tax income that doesn't exceed 6 million over the past 2 most recent years. Someone who's interested in starting an SBIC has to get a license through the SBA and has to meet a whole lot of requirements. So they are validated businesses, entities that are looking to fund, again, high growth ventures, but the venture has to be high growth, even though they are funded by the SBA. For every dollar that the general partner raises for the fund, the SBA will invest $2 at a very low interest rate with no payments due for the first either 5 or 10 years. The standard SBIC tend to focus on growth stage businesses rather than startups. So they're really not looking at you and I who are getting just started or are in our first year of operations. They're really looking at those businesses that have kind of taken hold and are growing at an exponential rate. Another source of funding is IPOs, initial public offerings. So this is the process of selling a typical minimum of $5 million worth of stock in the public market. Highly regulated by the Securities and Exchange Commission. That's what the SEC stands for. And once the company goes public, their shares are listed and traded either on the New York Stock Exchange or the NASDAQ, which is the National Association of Securities Dealers Automated Quotations. So this is a way in which businesses that have reached a certain size can do a one round of equity finance funding, right? They can say, okay, we're going to sell these many shares for this price, and on all the shares that are sold on that initial public offering day, all that money is provided to the business. And now there could be millions, hundreds, thousands of people that would own part of that business. When a business goes public, it's for a variety of reasons. They're wanting to raise capital for the operations of the business. They're wanting to gain legitimacy and credibility to recruit and retain top talent, and the ability to give them publicly traded stocks gives them that. It provides the business with another form of currency that can be used to further grow the company and further have business transactions with partners. And also it provides with a liquidity exit for the stockholders, including employees, management, and investors. Reasons why businesses sometimes, even though they have grown and they're successful, they choose to not go public. Well, it's less than 20% of entrepreneurs who attempt to take a company public are successful. So the rate of success is not very high in taking a business public. There's a lot of work that has to happen behind the scenes in order to take a company public. So it's not easy and it's not cheap. You have to work with an investment bank. They get paid, the lawyers get paid, the CPAs get paid, everybody gets paid. And so it tends to be a highly challenging deal. I've had the blessing of being part of two businesses that went public. And in both, I was with one employee number 16, and the other I was maybe employee number 28. So in both of those, I was at the ground level when they got started and saw the company grow and develop and become a publicly traded company. As I said, it's very expensive, around $500,000, so $500,000 for the initial cost. And most of the stock is owned by institutional investors who have a very short-term focus on the business, and all they want to see is profits. And so sometimes that may not be the only driver that we want to live by as owners of a business forever. Stock is owned by key management team, cannot be sold immediately because there's restrictions that the SEC puts on you. So these tend to be reasons why many businesses choose to not go public. For those seeking equity financing, but who do not want the complexity and challenges and expensiveness and time consumption that it would take to do an IPO, it's a DPO, direct public offering. If the business is seeking less than $5 million, that's what they want to raise, they can go directly to the public without going through the extensive and time-consuming IPO. The shares have to be valued or sold between $1 and $10, and they can be sold without an underwriter, which is usually what the investment bank would provide. And the investors also don't face the investor requirements that are set up under the SEC guidelines for an IPO. Typically, a DPO is best suited for a business that has been historically profitable, businesses that have audited financial statements, businesses that have a very well-defined and crafted small business plan. And the reason for these things is that usually in an IPO, your investment bank is the one that goes out and sells the idea that your business is viable, that your business is worth investing in, that your business has potential, that, hey, investors, you're going to make money. And they would have the data available and they would be communicating the data, all that good stuff. Unfortunately, in a DPO, there is no investment bankers that can do this for you. So your financial statements will have to tell the story and your business plan will have to tell that story. There's nothing that says that after you do a DPO, a direct public offering, that you cannot do an IPO. So even if you do a DPO and later on you think, well, we need to do another round of equity financing, you can still do a IPO. There's no perfect solution here. So what are some of the drawbacks of the DPO? Well, 70% of those companies that register for a DPO fail. So the success rate, it's not that much better than those that are filing for an IPO. There is no public market like the NYSE or the NASDAQ. Therefore, the ability to raise capital is negatively affected since the investments can't be quickly be made liquid. So investors tend to shy away sometimes from these types of investments. You don't have as much demand for these types of investments. And that could mean that your DPO cannot be as successful. And lastly, it leaves market appreciation of the stock in question. So what's the real value of the stock? And again, that's something that sometimes investors tend to worry about. So we have talked this lesson about the opportunity to acquire capital through debt or through equity. We've discussed what are the different sources of debt financing, as well as what is the different sources of equity financing. I know that I have shared with you a lot of information in this lesson, and that these might be things that as you further review your business opportunity, you prepare your business plan, things that you will have to come back to and evaluate and rethink. hopefully I provided you with plenty of resources to further explore opportunities for raising capital. There is tons of resources out there. There is a lot of good information that you should continue to learn and evaluate as you continue in your journey of acquiring the financial resources that you will need to either start your business or grow your business.